Good morning, everybody. It is Monday, May 5th, 2025. I am Herb Morgan, Senior Managing Director and Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly market and economic commentary. If I have something to say intro week, I will post it on both LinkedIn, follow me there please, at Herb Morgan, or on X, follow me there, at Herb W. Morgan. Everything you see and hear in this presentation is designed by us. We are an SEC registered investment advisor, but the opinions are mine and mine alone. They may differ from the views of our parent affiliates or other portfolio managers at the firm. There is no advice, there is no recommendation for the purchase or sale of any security. Well, we had another great week in equity prices. This numbers that would be considered a pretty good 6-month period, right? The S&P up almost 3% on the week. You can see here 2.9. Mid and small cap stocks outperforming, international outperforming. Look at international markets. Look at the EFI index, Europe, Australia, Far East Asia index, up 13.7 on a year-to-date basis. In an indication that there's really no sign of recession still, despite the hand-wringing that I hear every single day on the financial news. High yield, if there was a recession imminent, high yield spreads would be widening and we would have a negative return year to date, in my opinion, on high yield. We're not getting that. You can see interest rates, though, rallying a little bit year to date, not so much last week. Long dated treasury positive now for the year. So everything seems to be going fine. Let's get into the data from last week. We'll start with housing prices. I think one of the themes that's emerged in my mind in the last couple of weeks is that we are definitely now making progress on the inflation front. That doesn't mean prices are going to recede back to where they were. It means they're going to stop going up by as big a percentage as they were, and they're still going to continue to go up, but at a smaller percentage and getting closer and closer to the Fed's target. We're starting to see that in a number of areas. One very, very small area that we're starting to see that is home price appreciation has definitely slowed. Home price appreciation is measured by the FHFA House Price Index, up 0.1% in the month of February, 3.9 on a year-over-year basis. We haven't had a year-over-year below 4%, you can see, for quite some period of time. So that's welcome relief, not for your balance sheet, but for those certainly trying to afford and buy a first home. S&P Case-Shiller index was up 0.4, a little bit bigger gain there, 4.5 year over year. The difference is FHFA is anything financed with a government-sponsored enterprise mortgage, so maybe a little lower end, not necessarily. Case-Shiller broader, includes the higher end stuff. The higher end stuff seems to be holding in very firm. Another indication that perhaps there's no recession happening or imminent at this time. Pending home sales kind of surged last month. It was a surprise beat, up 6%. But remember, this is an annualized number. The numbers are very low for pending home sales, so you can have a decent month. Maybe January and February had some weather-related slowdown, and it sort of rebounded a little bit. But the other thing that happened last month is mortgage rates did dip down a little. Got below that psychologically important 7% level, and all of that would have contributed. Clearly the residential real estate industry is not out of the woods as it relates to activity and sales, etc. Then we got consumer confidence from the Conference Board for the month of April. The estimate was for 88. It fell to 86. This continues this theme I've been talking about. Look at this over on the right. This is soft data. This is how do you feel? What do you think? And I think this sort of manifests and reflects the opinions of people who don't necessarily have the belief in what the administration is doing around tariffs. Now, they may be convinced otherwise. If it turns out good, if it turns out bad, then their fears will be justified. But I think the coupling of the tariffs, the still persistently high prices of things, even though inflation is moderating, things are still expensive, whether it's homeowners insurance or what have you. This number at 86, last time we were at this level, you're going back really to COVID, right? You got to go to COVID to get levels these low. Current conditions fell. Expectations dropped significantly to 54.4. So this is telling me people are believing that a slowdown in economic activity is coming, even though the hard data does not yet support that. Let's take a look at some data. This is more soft. This is sort of a combo, I would say, but this is softer. Manufacturing PMI, anything above 50 is expansion, anything below 50 is contraction. About 15% of the U.S. economy. 50.2, barely expanded, but expanded nonetheless in the month of April. We move on to the ISM number, which has been consistently below 50 for about 3 years, with the exception of about three little ticks to the 50 line during that period. But we all know services is 85% of the economy, and that's been well above the 50 for some time. Hard data now, personal income. This is the income of us from our jobs, our dividends, our interest, our rents that we collect, all those different ways we collect income. All of us in the month of March said, hey, our incomes grew at 0.5%. That was above expectations, and they're 4.3% higher than a year ago. Personal spending was up 0.7, and that's up 5.6% year over year. So these are really strong, very solid numbers that suggest good things for our economy. Factory orders for the month of March were up big, 4.3%. Backing out transportation, they were down a little, 0.2%, and that's on the heels of a 0.3% gain in the prior month. And I told you last Monday that the GDP report would not be good, but I also said it would be nothing to worry about. And it would be nothing to worry about, I told you then, because of two things. First of all, third and fourth quarter GDP is spiked in an election year as the incumbent tries to push out government spending. Both parties do that, no exception last time with the Biden administration. So the quarter-over-quarter comparison becomes harder. The other thing, though, I said, is people want to get ahead of the tariffs, so that there was a huge surge in in imports, which led to a huge surge in inventories. And so that number came in, GDP was minus 0.3%. Okay, but net exports subtracted almost 5%, but then they put that stuff into inventory, which added 2.25%. It gets very confusing here. What matters is how the people are doing. Final sales to domestic purchasers and personal consumption up big, 1.8 on consumption, 3% on domestic purchasers. That tells me the economy is just fine, not to worry about it, and we move on. Lots of data on jobs and labor last week. We did have a little spike in initial claims for unemployment from an extremely low level of 223 the prior week to a very low level still of 241. Remember, weekly claims have been so good. I changed the scale on this chart a couple months back. Think about that. Changing this scale here, it had numbers like 400. And now I got the top at 270. This is a very low number and a very good reading. Continuing claims rose to 1.9. The spike there was in New York, where school workers, we do this every year, they actually are allowed to apply for unemployment benefits during the kids' spring break. I know that seems absurd. It's a week vacation, but that's how it works. And of course, that moves into the weekly for the nation as weekly initial claims for unemployment. They have a law. Even though they have a salary, they get a week off and they get to get unemployment benefits on top of the salary. Yes, you should be upset about that. Thank you. We're moving on, though, to job openings. Job openings fell from 7.5 million in February to 7.2. So that number is coming down. So the excess demand for labor relative to the supply, you can see, we call that equilibrium. Pretty much the numbers are right on top of each other. And that tells me that the excessive upward pressure on wages, which was a big contributing factor to inflation, is waning considerably. We then got both the ADP report and the BLS report. Private payrolls, according to ADP, only grew 62,000 in April. So that was a miss. Normally we're getting 140, 150,000. So that was a little bit of a miss. People were worried for about 48 hours. 48 hours later, the BLS report, or the U.S. Government Bureau of Labor Statistics report, comes out, and they say, no, our methodology shows we added 177,000 on top of the 185 we added in March, although March was originally reported at 228 and revised down. And the employment participation rate rose, so therefore, even though we added jobs, the unemployment rate remained unchanged at essentially full employment, 4.2% unemployment. Second month in a row where we had big auto sales. I still think that's people trying to get ahead of potential tariffs. You're thinking about buying a car, we might as well get it done before there's a 15 or 10 or 20 whatever percent tariff on it if you were buying an imported vehicle. So I'm not putting that into some giant resurgence in industrial production and manufacturing in the United States. No, quite the contrary. Just people moving to get ahead of tariff implementation. The big economic news of the week, as I've said it, I've sort of alluded to it throughout this podcast now. Inflation is starting to, again, move in the right direction. Kind of peaked in early 2022. You can see it here. We had some rapid deceleration. Then we had a plateau, and some people would say we were even starting to kick higher, and we were. And we were very concerned, and I was very concerned even recently as a couple of months ago. I'm still concerned, but less concerned than I was a month ago. March PCE price index was 0.0 and is now up 2.3% from a year ago. The core, which backs out the volatile food and energy components, was also 0.0 and is at 2.6 year over year. So those numbers, you can see them here. The Fed's target is 2.0. That's 2.0 right there. If the Fed goes through 2.0, they've have done their job, and they would be free to cut interest rates. Now, the Fed meets this week. Nobody believes they're going to cut rates this week. They have said publicly, no, we need to let this data continue to develop and evolve. But the market now sees inflation moderating, and the market believes the Fed will cut, not this week, but at maybe the subsequent meeting or the July meeting, they could cut. And we're seeing it in the break-evens markets, the Treasury break-even markets, which you can see here, look at the blue line, which is a 2-year expectation for inflation. Treasuries are the largest, most liquid, most efficient market in the world. And what the Treasury market says is usually pretty spot on. As recently as April 8th, so less than a month ago, they felt inflation was going to be 3.36% in the subsequent 24 months. That number is down to 2.7. And I made this graph on Friday. That was before Sunday's OPEC announcement of increased supply, which seems to be something that the administration had their hand in. They've been talking about bringing down energy prices as their method for combating inflation, because energy prices go into the production and transportation of literally everything. We were back in January, right? We were at $80 a barrel for oil. And as of this morning, we are at 57. That is a very significant percentage, right? That's a little more than 25% decrease in the price of energy, oil, the base unit of energy, I should say. So this is me saying, okay, I'm now ready to start seeing CPI, core PCE, other commodity prices, et cetera, go down. The other good thing that's been happening in the last couple of weeks, you've heard me talk about it, is earnings. The 357 names now. We had some big Mag 7 tech names last week. They did great. Average earnings surprise beat is 8.7%. Things like technology, which we're halfway done, good. Where's communications? We've had 14 of 25 names. Look at those. Look at that earnings average beat of 24%. These are big, giant, beautiful tech companies or communication services companies as they've been moved to because tech just got so big. I look at the two of these still really together, communications and tech. I look at them together. In terms of data this week, it's not a ton of data, but there's some important data. The services PMIs from both S&P and ISM are going to be this morning. Trade deficit will be Tuesday, expect about 136 billion. Fed will meet on Tuesday and Wednesday and make no rate cut, hike, etc. I expect them to begin to say something like, if inflation continues to trend in the right direction, we may see fit to further lower the Fed funds rate at the next or at a subsequent meeting, telegraphing, and that could cause the market to have a big run-up. Just that sort of statement alone this week, I wouldn't want to be short. Consumer credit, weekly claims going to drop down a little bit to 230 now that the teachers in New York have already made their claims. Non-farm productivity in the first quarter, labor costs, nothing on Friday. Remember, this is both the podcast and a video cast. You get the video on this guy, the YouTube. It is called Slaying Bulls and Bears. I look to make the complex and complicated simple and sensical every week. And I will be back to you again on May the 12th. Thank you, everybody, for tuning in, and see you next week.